Good morning, everyone, and welcome. I call this meeting of the NCUA Board to order, the first public meeting we've had since adopting a telework posture nearly 1 month ago. I want to note for the record that due to the COVID-19 pandemic, today's meeting is open to the public via a live webcast only. I'd also like to note that all participants in today's meeting are participating via telephone. This open meeting is also being recorded and will later be available on the NCUA website. I'd like to thank the NCUA Board Secretary and the Office of the Chief Information Officer for making today's hearing possible. In addition, I would also like to call attention to the Office of Chief Information Officers group for helping us all as an agency work remotely over the past month. I'd also like to thank the 1,141 men and women of NCUA. I am so proud of each and every one of you. I'd like to especially thank you for your professionalism and dedication that you've shown during this time of national challenge and uncertainty. You've worked diligently to ensure the personal health and safety for yourselves and your families, while also implementing the agency's business of ensuring the safety and soundness of our national credit union system. Your hard work has been evidenced by the ongoing support you've given our 5,200 plus credit unions. Such work has been the webinars that you've been conducting, the risk alerts, the letters to credit unions, and most notably, all of which has been captured on the COVID-19 webpage on our NCUA government website. I'd just like to thank you all for the great job you're doing and let you know that I am proud to have now been your colleague for the better part of now 1 year. The COVID-19 pandemic is more than a significant public health challenge. It also represents a serious challenge to the health of the economy. Just as our courageous healthcare workers and scientific researchers are striving to flatten the curve, the financial and corporate sectors are working to respond with alacrity to this pandemic. And while we hope for the best outcome, we still must prepare for the worst-case scenario. While working remotely, the National Credit Union Administration has worked continually throughout this crisis to provide clear guidance to the federally insured credit unions we oversee. Our top priority, along with ensuring the safety and well-being of our agency workforce, is to ensure the industry has the ability to continue meeting the financial needs of credit union members during this difficult time. And again, I appreciate the commitment and effort of all of the NCUA staff during this uncertain time. They have, without a doubt, risen to the challenge. Over the last few weeks, I've had the opportunity to speak with a number of credit union leaders to hear on-the-ground updates regarding how the COVID-19 pandemic is affecting credit unions and the members and local communities they serve. I've been impressed with how the industry has responded to this crisis. Credit unions across the country have moved quickly to protect employees and ensure continuity of service to member owners. I encourage industry leaders to contact NCUA with questions and concerns at COVID-19questions@ncua.gov so that we can continue to respond to the industry's needs as efficiently and as effectively as possible. Before I move to our first item for business today, I'd like to offer my fellow board members an opportunity to make any opening remarks regarding COVID-19 and to also acknowledge our agency staff. We'll start with you, Mr. Harper.
Thank you, Mr. Chairman. Like you, I have spent my days and weeks focused on mitigating the impact of the COVID-19 pandemic on the credit union system and ensuring that credit union members have access to much-needed credit during these difficult times. Last April, you and I took the oath of office and became NCUA board members. Neither of us had any idea that 12 months later, we would be in the midst of a global public health crisis. As we continue to face this significant challenge, I'm extremely proud of the work of the NCUA team. As financial first responders, they have risen to the occasion. They are working to identify problems, develop creative solutions, and bolster the credit union system for what lies ahead. Most of all, they are focused on the more than 120 million members of the credit union system who count on the NCUA to protect them and their share insured deposits and to ensure access to credit. In addition to internal briefings on economic activity, pandemic updates, examination program changes, and system development, I have also spent my time speaking with regulators, credit union leaders, industry experts, and consumer advocates. Through these calls, I have identified problems like the need to provide greater flexibility in holding annual meetings, assist credit unions in gaining access to the Small Business Administration's Paycheck Protection Program, delay comment periods on pending rulemaking, and facilitate access to grants and funding. Moreover, the NCUA staff has responded quickly to these problems, including, as I urged, securing the legislative changes needed to provide all credit unions with temporary enhanced access to liquidity through the NCUA's Central Liquidity Facility. The temporary changes made to the CLF are very helpful, but they may be too short in length because liquidity needs seem likely to hit their highest point next year. As such, I hope that we will ask Congress to make the Central Liquidity Fund provisions in the CARES Act permanent or extend the sunset by at least 1 year to December 31st, 2021. In any future legislative product, it would also be helpful to temporarily allow all member business loans made on or before the start of the COVID-19 public health emergency through December 31st, 2020 to be made exempt from the member business lending cap. This change would promote access to credit for small businesses and keep the economy going. Additionally, we have seen strong demand for urgent needs and COVID-19 emergency grants offered through NCUA's Community Development Revolving Loan Fund. Accordingly, I recommend that we seek an additional $10 million in appropriations for these emergency grants. The funding would help low-income credit unions to adjust their operations, preserve capital, and effectively respond to the many stay-at-home orders and social distancing mandates presently in place across the state to fight the spread of COVID-19. Because underserved communities are especially hard hit by COVID-19, we should request that Congress allow all federal charter types to add underserved areas to their field of membership. This common sense change would provide more Americans with access to safe financial products and services and affordable credit. Finally, in responding to the COVID-19 crisis, credit unions have less time to conduct the due diligence needed to respond to problems with their vendors. Consistent with the long-standing recommendations of the Government Accountability Office and the Financial Stability Oversight Council, now is the time to authorize the NCUA to supervise credit union third-party vendors. Doing so will close a regulatory blind spot and better protect the safety and soundness of the credit union system. In sum, Mr. Chairman, although the world has changed considerably since you and I joined the NCUA board, I am committed more than ever to serving the members and the credit unions that make up the system, as well as the NCUA staff. I will continue to advocate for common sense regulatory and legislative changes designed to mitigate this crisis. And while we will likely have many difficult days and more economic turbulence ahead, together we will get through the COVID-19 pandemic by focusing on serving the needs of credit union members. Thank you, Mr. Chairman. I have no further comments.
Thank you, Mr. Harper. We're now hear from Board Member McWaters.
Thank you, Mr. Chairman. First and foremost, I wish to express my thanks and appreciation to the staff of the NCUA. I have yet again witnessed the hard work and dedication that each of them has for the well-being of the agency and the credit union community. Nothing is more critical than their work to the fulfillment of the agency's mission. In my recent GAC speech and board statement on subordinated debt, I stressed the critical importance of liquidity and capital for credit unions and other financial institutions. Both the regulators and the regulated must at all times remain mindful that in a financial crisis or economic downturn, the fate of a financial institution depends upon its liquidity and capital levels. At the height of a financial crisis, when asset values may have fallen or collapsed precipitously, or cash flow has deteriorated unexpectedly, nothing matters more than liquidity or the ability of a financial institution to pay its debts and other obligations as they come due. In tandem with the role of liquidity, capital serves as a buffer to absorb the losses booked from declining asset values and the recognition of enhanced losses that inevitably follow an economic downturn and the often dramatic and unexpected end of myopic financial activity, a bursting asset bubble, or a wholly unexpected event such as the current COVID-19 pandemic. These points were made abundantly clear in 2008 with the $700 billion liquidity infusion implemented through the TARP program, and have arisen again today with the over $2 trillion CARES Act. With the growing number of economic disruptions, including the closing of credit union offices and branches caused by the COVID-19 pandemic, I am concerned that credit unions may experience liquidity and capital shortfalls as their members avail themselves of forbearance options, suffer job losses, or become unable to repay their auto, mortgage, and other indebtedness in the ordinary course. This also includes the liquidity, funding, and other commitments of credit union servicers under their servicing contracts and related obligations. As it is all but impossible to predict with certainty the economic consequences that may follow the closures, slowdowns, forbearances, job losses, and other pandemic-related fallout, it is important that we continue to thoughtfully and thoroughly monitor the liquidity and capital needs of the credit union community and individual credit unions to develop viable, transparent contingency plans that we may implement on short notice. Simply put, and without appearing needlessly alarmist, we must continue to develop an array of plans and approaches to address a financial crisis that may be developing at this time. In my view, this should serve as the agency's top priority. We owe this to the taxpayers and the approximately 120 million account holders who rely on credit unions for their financial services. Finally, I would like to offer suggestions for legislative action that would benefit the credit union system, the unserved, the underserved, and those of modest means, and assist the NCUA in carrying out its safety and soundness mission during the COVID-19 pandemic and beyond. 1, the creation of a permanent, separate and robust standby liquidity facility for the NCUA to employ as needed, or the permanent restructuring of the central liquidity facility to create the same. 2, capital reform to assist credit unions who may experience a downtick in capital from business and other closures, economic slowdowns, mortgage and loan forbearances, job losses, flights to credit union depository quality, and other COVID-19 pandemic-related consequences. 3, raising or eliminating the member business lending cap to assist small businesses and their employees, customers, suppliers, and communities. 4, permit all credit unions to participate as borrowers in the Paycheck Protection Program under the CARES Act and SBA regulations, as some credit union members risk joining the ranks of the unserved and underserved if their credit unions cease operations. 5, permit single common bond and community charter credit unions, not just multiple common bond institutions, to add underserved and unserved areas to their field of membership so as to expand access to federally insured financial institutions for the unserved, the underserved, and those of modest means. 6, expand the Community Development Revolving Loan Fund by an additional $10 million or more in appropriations to support low-income credit unions and small credit unions in assisting their members and those who are unserved and underserved. And 7, provide the NCUA with examination and enforcement authority over third-party vendors, including IT and FinTech-related vendors. In closing, it is important to note that the COVID-19 pandemic and crisis knows no boundaries. It impacts each of us throughout every community, regardless of our age, gender, ethnicity, or religion. It does not differentiate based upon our political status or the color of our state or jurisdiction. It's a systemic, relentlessly rolling disaster that we can address only by working together in a collegial, collaborative, and bipartisan manner. At the NCUA, I pledge to you that I will endeavor to ensure that we are all working together in utmost good faith to protect our staff and each employee, officer, director, and member of the credit union community, as well as the safety and soundness of the National Credit Union Share Insurance Fund and the credit union system. My thoughts and prayers are with each of you, and I wish you and your families, friends, and colleagues the very best in this unexpected and unwelcomed journey. Thank you.
Thank you, Mr. McWaters. The first item on our agenda today is a board briefing on Interim Final Rule Part 725, Central Liquidity Facility. Staff presenting Owen Cole, President of the Central Liquidity Facility, and Justin Anderson, Senior Staff Attorney, Office of General Counsel.
Good morning. This is Owen Cole, CLF President. Good morning, Chairman Hood, Board Member McWaters, and Board Member Harper. As you each have stated, there are a number of initiatives currently being undertaken by the NCUA to respond to the COVID-19 pandemic that is sweeping through the U.S., disrupting the lives of our citizens and causing volatility and uncertainty in our economy. As we will detail in this briefing, the Central Liquidity Facility, or the CLF, is a central component of the NCUA's contingency plans for responding to the potential impacts of this crisis. Specifically, we will cover recent enhancements made to the CLF resulting from 3 things. 1, temporary changes to Title III of the Federal Credit Union Act implemented by the passage of the Coronavirus Aid, Relief, and Economic Security Act, hereafter referred to as the CARES Act. 2, the adoption earlier this week of an interim final rule to Part 725 of the NCUA's rules and regulations. And 3rd, enhancements made to business operations designed to implement and facilitate certain newly established flexibilities arising from the changes to the CLF statute and regulations. As a reminder for our listeners, the Central Liquidity Facility is a mixed ownership government corporation created to improve the general financial stability of credit unions by serving as a liquidity lender to credit unions experiencing unusual or unexpected liquidity shortfalls. Member credit unions own the Central Liquidity Facility, which exists within the NCUA. The president of the Central Liquidity Facility manages it under the oversight of the NCUA board. I will now hand things over to Justin Anderson to walk you through the specific aforementioned changes to the statute and our regulations.
Thank you, Owen. This is Senior Staff Attorney Justin Anderson. Good morning. I will begin with the CARES Act. Section 4016 of the CARES Act makes 4 amendments to the CLF provisions of the Federal Credit Union Act. All of these amendments sunset on December 31st, 2020. First, the CARES Act removes the reference to primarily serving natural persons under the Federal Credit Union Act's definition of liquidity needs. This change permits temporary access to facility advances for corporate credit unions. Second, the CARES Act amended the CLF membership provision to provide greater flexibility to a corporate credit union serving as an agent member with respect to the amount it needs to pay to subscribe to the capital stock of the CLF on behalf of the natural person credit unions covered in its agent group. Third, the CARES Act removes the reference to the NCUA board disapproving applications for extension of credit that are filed with the intent to expand credit union portfolios. Instead, before approving an application, the NCUA board must first obtain evidence from the applicant that the applicant has made reasonable efforts to first use primary sources of liquidity, including balance sheet and market funding sources, to address its liquidity needs. Fourth, the CARES Act increases the board's borrowing authority on behalf of the CLF. The CARES Act temporarily increases this borrowing authority from 12 to 16 times the subscribed capital stock and surplus of the CLF. This means that during the temporary period, the CLF has 1/3 more borrowing power for every dollar of capital it can raise than it does under its normal authority. I will now discuss the changes made to the CLF regulation, Part 725. These changes, which were implemented in the form of an interim final rule and approved by the board earlier this week, were designed to either clarify and implement the changes in the CARES Act or augment those changes with additional flexibilities. Overall, staff believes the changes in the interim final rule will further enhance liquidity for credit unions during the COVID-19 pandemic. As I noted earlier, the changes in the CARES Act sunset later this year. As such, the changes in the CLF rule that correspond to the CARES Act will also sunset on December 31st, 2020. The corresponding changes in the regulation include, where appropriate, language addressing compliance after the sunset of a provision. The amendments made to the CLF rule include the following. First, the interim final rule amends the definition of liquidity needs to remove the words primarily serving natural persons. This change mirrors the statutory change in the CARES Act. Second, the interim final rule eliminates the 6-month waiting period on obtaining facility advances for a credit union that becomes a new member. This change was made in light of the overarching need to make such liquidity assistance timely. This change will not sunset. Third, the interim final rule amends the structure of the requirement for a corporate credit union to subscribe to the capital stock of the CLF. This change, which mirrors the statutory change in the CARES Act, allows the board, in its sole discretion, to determine which grouping of natural person member credit unions of the applying corporate credit union are considered covered by the agent's membership in the CLF. In turn, this approved group is the basis for calculating the amount of CLF capital stock the corporate credit union is required to purchase. This will provide a corporate credit union with the flexibility to subscribe to the capital stock of the CLF for a subset of its membership and thereby reduce the potential cost of serving as an agent. Fourth, the interim final rule adds a clarifying amendment to Section 725.4 to effectuate the intent of the CARES Act in a safe and sound manner. Specifically, this amendment clarifies that an agent member may borrow from the CLF for its own liquidity needs, but to do so, it must first subscribe to the capital stock of the CLF in an amount equal to 0.5% of its own paid-in and unimpaired capital and surplus. This is designed to be wholly consistent with how the facility grants extensions of credit to its natural person credit union members. By expanding the liquidity resources of corporate credit unions in this way, even for a temporary period, it adds a measure of liquidity strength for the system as a whole. Fifth, the interim final rule amends the waiting periods for a credit union to terminate its membership in the CLF between the effective date of the interim final rule and January 1st, 2022. Under the Federal Credit Union Act and Section 725.6 of the NCUA's regulations, a credit union may terminate its membership after a specified amount of time based on the credit union's stock subscription in the CLF. Before this interim final rule, a member of the CLF could terminate its membership in 6 months if it held less than 5% of the outstanding CLF capital stock, or in 24 months if it held 5% or more of the outstanding CLF capital stock. The interim final rule amends this section of Part 725 to temporarily permit a credit union, regardless of its percentage of amount of stock subscription, to withdraw from membership after notifying the NCUA board in writing on the sooner of 6 months from the date of its written notice to the NCUA board, or December 31st, 2020. Further, any credit union that remains a member after December 31st, 2020 may, under this amendment, withdraw from membership immediately upon notifying the board in writing of its intent to do so. This immediate withdrawal period will expire on December 31st, 2021. On January 1st, 2022, the normal termination requirements will be reinstated and apply to all members. Staff believes that adding this flexibility will potentially encourage a greater number of eligible credit unions to join the CLF and support the agency's COVID-19 response efforts. Finally, the interim final rule reduces the amount of collateral required for certain assets used to secure each facility advance and each agent loan. Prior to this interim final rule, Section 725.19 required that each facility advance and each agent loan be secured by a first priority security interest in collateral of the credit union with a net book value of at least 110% of all amounts due under the applicable facility advance or agent loan, or by guarantee of the National Credit Union Share Insurance Fund. This interim final rule replaces the 110% requirement with the requirement that a credit union collateralize a facility advance or agent loan in accordance with the facility collateral table, which is posted on the NCUA's website. The collateral table varies the required collateral percentages based upon different types of assets, and in some cases requires less than 110%. Depending on the types of assets a member has available to secure an advance request, this may ease the collateral requirement somewhat and permit a greater amount of borrowing overall. This provision will not sunset. This concludes my overview of the changes to the Act and the NCUA's regulations for the CLF. I will hand things back to Owen to discuss some of the corresponding changes we're making to CLF operations and to summarize this briefing. Thank you.
Thank you, Justin. And this is Owen Cole. As we face the welcome prospect of adding new regular members and constituting a new agent network for the CLF, we are busy making some applicable changes to many incidental components of our policies and procedures for how membership and loan transactions will occur. We are implementing easier application forms for new members by making some of the documentation more streamlined, automated, and web-based. The computation for a new member stock subscription amount, for example, will automatically pull the necessary information from call report filings to make the computation both faster and more reliable. On the loan side, we plan to reduce the list of materials required to support an advance request, as much of what the CLF needs to assess creditworthiness and liquidity condition can be obtained from call report and examine supervision information. For loans that come through the corporate credit unions acting as agents, we can rely upon existing documents and facilities already in place between corporates and their members to perfect our security interest and distribute funds once a loan is approved. The last thing I'll mention on the operations side is that we have identified specialized staff within the organization who can be shifted to the CLF underwriting team under the direction of our facility loan officers to handle any potential surge in volume that might occur if the crisis triggers a more widespread demand for liquidity funding. And while we are not saying that this will occur, we have plans in place to flex our capacity upwards to handle increasing demands if and when that need arises. In closing, I want to emphasize these changes to the CLF that we've outlined today give us a significant increase in our ability to add new members. Our enhanced ability to grow the facility's membership, in turn, enhances its ability to borrow increasingly greater amounts of funds to provide liquidity to the credit union system. By significantly increasing access to external funding, the facility can better fulfill its central purpose to improve general financial stability by meeting the liquidity needs of credit unions. As a reminder, the facility is able to borrow from the U.S. Treasury. The facility's ability to borrow from the U.S. Treasury's Federal Financing Bank was an essential element of the NCUA's and the credit union system's ability to work through the last economic crisis. And today, we believe it is again positioned in a stronger way to do the same as we navigate the challenges of the COVID-19 pandemic. That concludes our report. We'd be happy to answer any questions that you may have.
Thank you, gentlemen, for your presentation. Earlier this week, the NCUA board unanimously approved by notation vote an interim final rule that enhances the ability of the Central Liquidity Facility to serve as a liquidity backstop for the nation's credit union system. The CLF, a mixed ownership government corporation that serves as a form of liquidity insurance for credit unions, can borrow from the U.S. Treasury and use those funds to make loans to member credit unions and the National Credit Union Share Insurance Fund. This borrowing power was an essential element in helping the credit union system work through the last financial crisis. Liquidity, like capital, is a pillar of strength upon which the safety and soundness of the credit union system rest. While we hope for the best outcome to the current emergency, we need to prepare for the possibility that the CLF will once again prove vital in addressing the liquidity needs for credit unions and the Share Insurance Fund. We know from our previous experience with the last financial crisis that addressing liquidity needs aggressively reduces the corresponding threat to capital adequacy. Right now, we are indeed facing an unprecedented disruption to our economy, and we do not know for sure how the situation will unfold and what the fallout might be. It is difficult to forecast. However, we must take steps to persevere and preserve our system's capacity and to safeguard its members. Credit unions, since their earliest formation, have always provided critical financial assistance to their members, especially those of modest means and with limited access to credit and other affordable financial services. Bolstering our system's liquidity strength right now is necessary to ensure that our nation's credit unions remain stable and strong and continue delivering quality and affordable financial services to more than 120 million member owners they serve. I want to remind our stakeholders about the necessity of having a robust contingent liquidity resource, one that is able to meet rapid, volatile, and unexpected conditions. I want to emphasize that liquidity needs are of a nature that, if not addressed swiftly and decisively, can translate into rapid financial distress for individual institutions or even the broader system. The actions taken by the NCUA board to enhance the CLF are proactive steps that are designed to alleviate potential liquidity strains and are undertaken with expedience to ensure the maximum intended effects are in place at the earliest opportunity. The events of this pandemic have unfolded rapidly in a few short months. The effects and implications already require new additions to our risk management playbook. We are reminded that even long-standing contingency plans sometimes must be augmented with modifications and aggressive action to counter developments that are simply beyond our previous crisis management experience. The board and the agency staff are working tirelessly to implement response measures like the current changes to the CLF, which will help us remain abreast of these rapidly unfolding events. By doing so, we strive to keep the system sufficiently liquid and reliably operational. Most importantly, we make good on our mission to ensure credit unions can deliver quality and affordable financial services to their member owners without disruption while remaining safe and sound. The CLF is indeed a proven solution for individual credit unions and for helping stabilize liquidity throughout the credit union system. While we're confident the credit union community will remain safe and sound, These temporary measures will help ensure sufficient liquidity is available and to the extent that the COVID-19 impact has been fully determined. By working together in the cooperative spirit of which the industry was founded, the credit union community can assist one another in ensuring the system has adequate liquidity and thus maintain the health of the credit union system as we prepare for the economic recovery to come. Now, gentlemen, I do have a few questions. You mentioned that you are planning to dedicate additional specialized staff to the ranks of the CLF underwriting team as necessary. Can you please tell me how we are able to quickly transition such staff into place, and how can we ensure consistency in the loan review process?
This is Owen Cole, Mr. Chairman. I can answer that question. What we have done to prepare for a possible increase in liquidity lending is to borrow a page, as you mentioned, from our playbook for the last financial crisis back in 2008-2009 timeframe. During that period, we experienced a surge in liquidity advances and needed to stage in and deputize loan officers for the facility. We have a cadre of both regional capital market specialists as well as lending specialists here in the national office that have the experience and skills to evaluate these transactions and quickly recommend the appropriate action. Because the agency has curtailed examinations and supervision contacts as part of the COVID-19 response efforts, we have the capacity in our ranks that normally would be conducting those activities. How do we ensure consistency? Well, we will onboard folks with orientation training to refamiliarize them with how the facility advances work. And importantly, we use objective criteria from the call report to dimension both the creditworthiness and the liquidity circumstances for each advance. So all the underwriters have some automated information and thresholds that they can generate immediately. And we augment this with call report, we augment that call report data with exam and supervision information as well. All of the loans are vetted by our senior facility loan officers before final approval, and we also confer with the regional director and the state supervisory authority for state charters before a final decision is made. So in this way, we have defined standards that ensure we are highly consistent in our treatment of borrowers.
Thank you. We are currently operating all of our businesses in a remote posture, agency-wide. Do you feel that these new membership applications and liquidity loan requests can be handled through our remote operating processes?
This is Owen Cole. Yes, I do think we can handle this fairly smoothly under our remote configuration. Many of our staff are, as you earlier mentioned, are already remote workers who have the equipment and facilities to carry out their duties from a non-centralized location. But we've also provided remote capabilities for most all of our central office staff as well, including conference lines and video meeting capabilities. Most of us are now getting acclimated to these temporary virtual office and meeting processes. And importantly, we've designed our contingency operating procedures to handle this for the foreseeable future.
Thank you. And one final question. Can you elaborate on why it's important for credit unions to join for the system as a whole, even if they do not believe they will have liquidity needs?
This is Owen Cole again. This is a very important consideration. Why is it important for credit unions to join even if they think they won't have a liquidity need? And there are really two dimensions to increasing membership in the CLF. And one is fairly obvious, which is that the CLF provides individual credit unions with a federal contingent source of funds that is a highly reliable form of insurance should that credit union experience an unexpected disruption to their operations or business that creates an unplanned need for funding that ordinary sources simply can't meet. While remote, that is not an improbable occurrence for depositories. But the second issue may not be as obvious. We have a liquidity facility that can both lend to individual credit unions, but also to the Share Insurance Fund. Because of the multiplier effect of our borrowing authority, building the critical mass of CLF membership has an exponential effect on its access to money from the Federal Financing Bank. And there have been times, such as the last financial crisis, when the CLF was able to borrow and inject tens of billions of dollars into the credit union system to stabilize the financial footings for the industry and the insurance fund, when we needed time to develop a long-term solution for resolving the failed institutions from that period, the cost of which are borne by all federally insured credit unions. So I guess said another way, having access to large amounts of liquidity buys you time to deal with distress and reduces the risk of insolvency and its cost. And as you said earlier, we don't know how much liquidity we may need as a system to get through this pandemic, but I think we do know that more liquidity is almost certainly better in times of crisis. And so those are the reasons why we feel that individual credit unions may wish to join even if they don't think they'll have to borrow themselves.
Thank you, Owen. I couldn't agree with you more. Thank you. I have no further questions. I'd now like to give the floor to Board Member Harper.
Thank you, Mr. Chairman. And Owen and Justin, thank you for your presentation today, as well as everyone who worked on this rulemaking, including Myra, Anthony, Larry, and Frank. I appreciate the hard work and speed with which the Central Liquidity Facility interim final rule was crafted. The COVID-19 pandemic has created public health and economic risks that impact everyone. During these challenging times, I have focused on mission-critical services aimed at containing these risks and ensuring that credit union members are protected and that the credit union system remains safe and sound. Because credit unions need to have access to liquidity when other parts of our economy freeze up, I called on the NCUA to seek legislation to enhance the capacity and powers of the CLF. Congress acted quickly to adopt those temporary enhancements as part of the CARES Act, and I am grateful to each of the NCUA staff who worked to make that possible. The NCUA staff have now acted expeditiously to draft the interim final rule to implement these reforms. I voted in favor of that rule last week. These changes will provide the system with a sustainable source of liquidity during the COVID-19 pandemic and the ensuing economic uncertainty that seems likely to continue into 2021. For that reason, I urge all natural person and corporate credit unions that do not already belong to the Central Liquidity Facility to join as soon as possible. Owen just made the point about the exponential effect that we can have in liquidity if more credit unions join the Central Liquidity Facility. As we work to implement these statutory changes, there are new legislative vehicles currently making their way through Congress to address more COVID-19 related issues. In one of those bills, the NCUA should request that Congress lift or extend the sunset of the CLF amendments contained in the CARES Act. The temporary changes made to the Central Liquidity Facility are very helpful, but they may be too short in length because liquidity needs seem likely to hit their highest point next year. As such, I believe that we should make the Central Liquidity Fund provisions in the CARES Act permanent or extend their sunset by at least 1 year to December 31st, 2021. As I stated earlier, these important enhancements will provide the system with the necessary liquidity during the COVID-19 pandemic and subsequent economic uncertainty that seems likely to continue for the immediate future. Thank you again for your presentation, Owen and Justin. Mr. Chairman, I have no questions and no further comments.
Thank you, Board Member Harper. I'd now like to recognize Board Member McWaters. Board Member McWaters, we are not hearing you. I don't know if there is some chance that you may be muted, sir.
I'm sorry, Mr. Chairman. Actually, I was muted. I apologize for that. I want to thank the NCUA staff for their work on the CLF notation vote items that we addressed a couple days ago. These are very, very important. They're very mechanical, but without them, the CLF would be substantially impaired. But let's be clear when we look at the CLF for what it is even today. If more credit unions do not join the CLF and we do not receive that multiplier effect, which is either, whichever way you look at it, it's a 16x or 32x multiplier, which is substantial. If we do not receive that, then the CLF, even under these rules, is going to be potentially inadequate to meet any kind of liquidity crisis that we could face. So it's, as Board Member Harper said, as the Chair said, it's critically important for credit unions to reach out and join the CLF. That will build a liquidity facility for the NCUA. Now, this is an awkward way to do business as far as I'm concerned. Here we are trying to address the COVID-19 pandemic, and we're trying to cobble together a liquidity facility for a regulator that oversees $1.5 trillion of assets and financial institutions that serve 120 million Americans. Many of them are middle class and struggling to join the middle class. It's just a very awkward way to do business. The NCUA, as an agency, we should have our own robust standby liquidity facility that we can depend on, that the credit union community can depend on. So when the next crisis, and there is always a next crisis, comes along, we just simply know it's there, everyone knows it's there, and there is comfort to it. So I commend those on the NCUA staff, as the Chair said, as Board Member Harper said, that we have a lot of work to do on the Hill to get this implemented. We don't know what the future holds, but we do know that there are credit union servicers who may have to pay out principal and interest obligations. They may have to pay out property tax obligations. At the same time, they have members who have lost jobs and who are depositing fewer paychecks, have members that are availing themselves of forbearances and are making fewer payments on their auto and mortgage loans, and who otherwise just have less cash flow working through the system. So this is hugely important, and I commend credit unions to join the CLF for the good of the cause. Thank you so much.
Great. Thank you, Board Member McWaters. Before we move on, I would like to also thank another person from NCUA who played a pivotal role in helping us with our legislation that was in the CARES Act, and that is Giselle Roget, Deputy Chief of Staff and Head of our Office of External Affairs and Communication. Giselle worked tirelessly with members of Senate Banking and the Majority Leader staff till almost midnight before the CARES package went to the Senate. So between her help, and then she was able to advise me, you all, when I met with them literally before the Senate vote took place, where we negotiated literally before they went into the chamber, our getting the 16 times the borrowing authority. Congress had recommended a different amount, and we were able to negotiate from that amount to the 16 times today. But you all, that would not have been possible without Giselle Roget and her leadership role. So I would just like to publicly thank her for the role she played, and the next role that she will play as we look for the next regulatory relief effort. So thank you. Ladies and gentlemen, the second item on our agenda today is the Temporary Final Rule, Part 701, Regulatory Relief in Response to COVID-19. Staff presenting, Meyer Tope, Acting Director, Office of Examination and Insurance, Justin Anderson, Senior Staff Attorney, Office of General Counsel, and Ian Marina, Associate General Counsel.
All right. Good morning. This is Myra Tepe, Acting Director of the Office of Examination Insurance. We are here today to present the final rule that temporarily modifies certain regulations to help provide credit unions with additional flexibilities and relief in response to the COVID-19 pandemic. These temporary modifications will be in place until December 31st, 2020. I will turn it over to Justin Anderson to discuss the first two changes made by the final rule.
Thank you, Myra. This is Senior Staff Attorney Justin Anderson. Good morning again. The final rule temporarily suspends limitations on the eligible obligations that a federal credit union may purchase and hold. Section 107.13 of the Federal Credit Union Act authorizes a federal credit union to purchase, sell, or pledge all or part of an eligible obligation to one of its own members. The NCUA has implemented and interpreted this provision in Section 701.23b of the NCUA's regulations. The current rule provides that a federal credit union may purchase an eligible obligation from any source, provided the federal credit union is empowered to grant the loan or the loan is refinanced within 60 days following its purchase, so that it becomes a loan the federal credit union is empowered to grant. The purpose of the refinancing requirement is to help ensure that loans purchased by a federal credit union comply with the statutory and regulatory requirements applicable to loans made by a federal credit union. This policy, however, is not compelled by the statutory language in Section 107.13 of the Federal Credit Union Act, which speaks solely to loan purchases. Given the COVID-19 pandemic, we believe that a closer reading of the statutory text is merited, and we recommend suspending the refinancing requirement for a temporary period to promote the extension of credit and flow of liquidity in the credit union system generally. As I've noted, the Federal Credit Union Act and Section 701.23 generally do not authorize a federal credit union to purchase loans unless the person liable on the loan is a member of that credit union. Section 701.23b2, however, provides certain limited exceptions to the general membership requirement for well-capitalized federal credit unions with composite CAMEL ratings of 1 or 2. As the board has previously noted, these types of purchases could be construed as purchases of credit union assets pursuant to Section 107.14 of the Federal Credit Union Act, which does not impose a membership requirement. Given the urgent need to support the extension of credit and facilitate downstream loan purchases as a tool to manage liquidity, the final rule temporarily authorizes federal credit unions with composite CAMEL ratings of 1, 2, or 3 to purchase eligible obligations of federally insured credit unions and liquidating credit unions, regardless of whether the obligations belong to the purchasing federal credit union's members. I will now return the presentation to Myra, who will discuss the remaining changes.
All right. Thank you, Justin. The temporary rule revises Section 702.22b52 to raise the maximum aggregate amount of loan participations that a federally insured credit union may purchase from a single originating lender to the greater of $5 million or 200% of the credit union's net worth. The current aggregate limit is set at the greater of $5 million or 100% of net worth. The purpose of the current provision is to mitigate the exposure of federally insured credit unions to concentration risk. However, we believe regulatory flexibility is warranted during the present COVID-19 pandemic when many credit unions are seeking to maintain adequate liquidity through the sale of loans or participations. Additionally, this change is consistent with the NCUA's 2018 Regulatory Reform Agenda recommendation related to this provision and does not pose an undue risk to the Share Insurance Fund. The final rule also suspends the required timeframes for the occupancy or disposition of certain properties acquired by the credit union. Section 701.36 of NCUA's regulations requires that a federal credit union partially occupy premises within 6 years after acquisition. Additionally, a federal credit union must advertise for sale premises that have been abandoned for 4 years. In response to the COVID-19 crisis, many states and localities have implemented physical distancing measures to stop the spread of the disease. These restrictions make compliance with the regulatory deadlines extremely difficult. Accordingly, the final rule suspends the regulatory mandated timeframes. Any days that fall within the date of the temporary final rule's publication in the Federal Register and December 31st, 2020 will not be counted for purposes of determining a federal credit union's compliance with the required time periods. That concludes our prepared remarks. We will be glad to answer any questions you may have.
Well, thank you all for your presentation this morning. And thanks also to the Office of General Counsel and Examination and Insurance teams for their hard work to bring this rule to fruition in such a short time frame. This final rule represents an additional step in our ongoing efforts to protect the safety and soundness of the credit union industry and to ensure the well-being of credit union member owners during the COVID-19 crisis. In maintaining my regulatory philosophy of keeping regulation effective but not excessive, this rule will temporarily relieve credit unions of regulatory burdens that might have otherwise hindered their ability to maintain operations and meet the needs of borrowers who are experiencing economic hardship. While these temporary amendments will provide credit unions with additional flexibility, they are also prudent and consistent with the NCUA's responsibility to maintain the safety and soundness of the overall credit union system. This temporary final rule amends provisions that will be temporarily expanding credit unions' authority regarding purchasing loans and participations in loans, thereby promoting the extension of credit and enhancing the ability to meet liquidity needs. The temporary final rule raises the amount of loan participations that a credit union may purchase from a single originating lender without the need for a regulatory waiver, and suspends certain limitations on the types of eligible obligations that credit unions may purchase. The temporary final rule also addresses a regulatory requirement that may be difficult, if not impossible, for credit unions to meet during the crisis. Given social distancing policies, the temporary final rule suspends the deadlines for the occupancy or disposition of properties not being used for credit union business. As I've made clear on numerous calls that I've made to credit union leaders throughout the pandemic, the NCUA is ready, willing, and able to work with credit unions in responding to these unusual and difficult circumstances. We want to provide credit unions with the flexibility needed to adjust their policies in response to member owner needs. I believe this final rule represents a great opportunity to do just that. The temporary final rule temporarily streamlines our regulatory requirements without introducing undue risk. While this temporary rule does offer relief to credit unions, I think it is important to note that this will inevitably extend to borrowers as well. I now have a few questions. Would you explain why the rule omits the typical request for comments during the comment period?
Thank you, Mr. Chairman. This is Justin. I will answer that question. The Administrative Procedures Act, or APA, which governs rulemaking by federal agencies, generally requires that agencies first issue their rulemaking proposals for public comment. The APA, however, does allow agencies to admit advance notice and comment procedures when the agency, for good cause, finds that the comment period would be impracticable, unnecessary, or contrary to the public interest. We believe that given the widespread impact of the COVID-19 pandemic and the speed of the resulting disruptions, ordinary notice and comment procedures are impracticable, and that moving expeditiously in the form of a temporary final rule is in the best interest of credit unions and the public generally. It is true that the board often solicits comments on rules even when not required under the APA, such as for the rules it issues on an interim final basis. The amendments made by this temporary final rule, however, will automatically expire at the close of December 31st, 2020, and are limited in number and scope. For these reasons, we believe that there is good cause, consistent with the public interest, to issue the rule without notice and comment.
Thank you. The relief provided by this final rule is temporary and set to expire at the close of December 31st, 2020. Will the board have the opportunity to extend these flexibilities should it become necessary in order to address the needs of credit unions and their member owners?
Chairman, this is Justin again, and I will answer that. Yes, the board may elect to issue a rule that would extend these effective dates in the temporary final rule.
Thank you, and I have one final question. Does the rule address how the NCUA will treat credit unions that use the flexibilities provided by this rule following the sunset date?
I'll take that one, Chairman. Yes, this is Myra Tepe. Yes, as you noted, these regulatory changes are set to expire on December 31st of 2020. For credit unions that purchase loans under the expanded authority in Section 701.23, these loans will be grandfathered and the credit union will be permitted to continue to hold them after December 31st of 2020. However, any new purchases will need to comply with the regulations in place at that time. Credit unions that have purchased loan participations from a single originator under the temporary authority will be able to retain those participations they had purchased, but credit unions would not be able to buy additional participations from that lender unless it was below the regulatory limit in place after December 31st, 2020, or they obtained an approval waiver from the regional director. After the termination of this interim final rule, credit unions would be expected to submit any waiver request in accordance with the applicable regulation. However, NCUA staff will work with credit unions on a case-by-case basis when reviewing and approving waivers, taking into account the impact of the COVID-19 pandemic.
Thank you. I have no further questions. I'd now like to recognize Board Member Harper.
Thank you, Mr. Chairman, and thank you, Myra and Justin, for your presentation today, and thank you to everyone who worked on this rule, including Amanda, Ian, and Ariel. During these times of economic uncertainty, we must move quickly to prepare the credit union system for what lies ahead. One way in which we can prepare the system is to provide sensible, short-term regulatory relief. I commend the teams in the Office of Examination and Insurance and the Office of General Counsel for their expeditious efforts to draft the interim final rule providing regulatory relief in response to COVID-19. This temporary and targeted rule will create more tools that credit unions can use in case liquidity or certain operational issues arise during the pandemic. In supporting this emergency rule, I want to make it clear that we would need to follow the normal rulemaking process of seeking public comment before making any of these changes permanent. The information obtained in any such rulemaking may affect my future views on the advisability and merit of these matters. That said, agency experts have assured me that these changes are consistent with safety and soundness, and I will follow their advice. I have no questions for you, Myra or Justin. Thank you, Mr. Chairman. I have no further comments.
Thank you, Board Member Harper. I'd now like to recognize Board Member McWaters.
Thank you, Mr. Chairman. I agree with what you said and with respect to what Board Member Harper said. Thank you, Myra, Justin, Frank, and all the others who have worked on this rule on an absolutely expedited basis. And I think you produced a good rule. As I've said many times, rules need to be tailored and targeted to the actual risk presented, and I think that we have done that here. So with that, I have no questions, and I will turn that back over to you, Mr. Chairman.
Thank you, Mr. McWaters. Is there a motion? I move that the board approve temporary final rule part 701 of NCUA. Oh, go ahead.
I'm sorry, Mr. Chairman. I had it on mute. Mr. Chairman, this is Board Member Harper. I move that the board approve temporary final rule Part 701 of NCUA Rules and Regulations for publication with an immediate effective date as attached to the Board Action Memorandum.
Thank you. Is there a second to the motion?
Second, Mr. Chairman.
There is a sufficient second. All in favor, say aye. Aye.
Aye.
All opposed, say nay. The ayes have it, and let the record show the motion passed 3-0. Thank you all. The third item on our agenda today is Interim Final Rule Part 722, Real Estate Appraisal Relief. Staff presenting, Tim Segerson, Deputy Director, Office of Examination and Insurance, and Ian Marina, Associate General Counsel, Office of General Counsel.
Good morning. This is Tim Segerson. Good morning, Chairman Hood, Board Member McWaters, and Board Member Harper. We are presenting a proposal regarding appraisals relief as interim final rule, or IFR, as a temporary measure to separate from the permanent threshold change we just discussed. I'm sorry, I'm out of order. The IFR is intended to provide immediate relief given the current conditions throughout the United States. This IFR permits credit unions to complete mortgage loan transactions even if they are unable to obtain a required appraisal or written estimate of market value, provided they obtain the required appraisal or written estimate of market value within 120 days from the closing date. The IFR was developed in consultation with the federal banking agencies as a temporary measure to provide immediate relief from the current difficulties many institutions are experiencing obtaining appraisals and written estimates of market value. The measure will prevent delays in closing mortgage loans and allow small businesses and homeowners to tap much-needed equity in their homes and business properties to help them weather the economic conditions caused by the national health crisis. Appraisals and written estimates of market value are generally required before loan closing to establish the collateral value of real estate transactions. However, current conditions have disrupted the normal appraisal and written estimate of market value timelines. Social distancing, shelter-in-place mandates, and a fear of COVID-19 transmission has resulted in delays obtaining appraisals and written estimates, which often include an in-person or physical inspection of the real estate collateral. The FFIEC agencies, state authorities, housing agencies, and housing enterprises have all taken steps to provide relief to this problem through relaxed requirements, especially relief from the requirement to conduct an internal inspection of the property by appraisers and evaluators. The FFIEC agencies and state authorities also jointly issued a statement on relief that included existing flexibilities within the current appraisal regulations, including, for example, that appraisals and written estimates of market value under agencies' rules do not require a physical inspection of the property. The agencies also highlighted the ability to refinance a mortgage with limited or no cash out without obtaining an appraisal or written estimate of market value as part of the existing flexibilities in our rule. While the jointly issued statement on flexibilities and agency relief should address many of the concerns currently raised by financial institutions in acquiring an appraisal or written estimate of market value, the banking agencies and NCUA work closely on this IFR to provide additional immediate relief tailored to the unique circumstances of the current crisis. The deferral permitted by the IFR can be used by credit unions in the event they are unable to obtain a necessary appraisal or written estimate of market value to timely close a transaction. To provide temporary relief for liquidity to the real estate market, the IFR would defer the requirement to obtain an appraisal or written estimate of market value up to 120 days after loan closing. This would provide homeowners and businesses with peace of mind of having access to funds at the earliest possible time. Due to timing issues of the IFR, we couldn't complete this simultaneously with the banking agencies. However, this IFR was done in close consultation with other members of the FFIEC and is identical in all major respects to relief provided by the banking agencies. Due to the widespread impact of the COVID-19 crisis, the IFR is intended to benefit a broad section of the real estate market. Any loan transaction to purchase or refinance residential or commercial real estate is covered under this IFR. We would note that there is no limit to the size of the transaction as well. We believe not having this dollar restriction would broaden the number of homeowners and businesses that could benefit from having access to liquidity during the crisis. NCUA, like the other agencies, excluded one type of loan from this relief. Acquisition, development, and construction loans are excluded due to the unique risks of the loan product and the speculative nature of the collateral. To ensure quick relief to homeowners and businesses, the IFR will be effective immediately upon publication in the Federal Register. The IFR will apply to covered residential and commercial real estate transactions until December 31, 2020. This timeline generally coincides with timelines for other notable relief measures enacted by the federal government, including major provisions of the CARES Act. A December 31, 2020 expiration would allow credit unions that originated a loan on the last day of 2020, December 31, 2020, until April 30, 2020 to obtain the required appraisal or written estimate of market value. Before credit unions take advantage of a deferral afforded by the IFR, it should use its best efforts to obtain the required appraisal or written estimate of market value. This can include exterior-only appraisals, known as drive-by appraisals, or desktop appraisals. Both of those appraisal types will meet USPAP standards, Uniform Standards for Professional Appraisal Practices. There may also be pockets in the United States, for example, where appraisers or evaluators are operating with minimal disruption to their business. So before a credit union chooses to defer, they should contact appraisers and evaluators and schedule the appraisal or written estimate of market value at the earliest time. It is important for credit unions to understand that this temporary relief is not a waiver of requirements, and required appraisal or written estimates of market value must be obtained within the 120-day window. By the end of the 120-day deferral period, a credit union must obtain a USPAP-compliant appraisal or written estimate of market value appropriate for the real estate transaction type as laid out in NCUA's regulations. NCUA's regulations surrounding general and commercial lending, have always required credit unions to originate loans consistent with safety and soundness principles. A decision to extend credit should be supported with, among other things, a credit analysis that demonstrates the borrower's capacity to repay, and an analysis of collateral value as a secondary source of repayment. Credit unions have flexibility, but should exercise good judgment in determining collateral value in the absence of an appraisal or written estimate of market value. For example, the tax assessment value can be used as an estimate of market value or as a good starting point for that. The IFR does not change this expectation for credit unions to exercise prudence in underwriting loans during the IFR term. In exercising the flexibility to defer appraisals or written estimates of market value, credit unions will be expected to have a risk mitigation strategy in the event property valuations come in significantly below original estimates when the appraisal or written estimate of market value are finally obtained. Such risk mitigations could include adjusting risk ratings, requesting additional collateral or guarantors, or using other measures. To deliver immediate relief and liquidity to homeowners and businesses, staff recommends the board approve the interim final rule to defer appraisals and written estimates of market value for up to 120 days after the closing of a real estate loan transaction to expire on December 31, 2020, and with an immediate effective date upon publication in the Federal Register. That concludes our remarks, and we'd be happy to answer any questions.
Thank you for your presentation this morning. The current public health crisis and subsequent social distancing directives have created difficulties for lenders to obtain required appraisals on a timely basis. As a result, borrowers may be prevented from refinancing loans and gaining access to much-needed equity on their real estate in these uncertain economic times. Access to credit is the lifeline of many communities and families and will be necessary for them to recover from any economic damage done by the COVID-19 pandemic. By deferring appraisals and evaluations up to 120 days, this rule will help bring relief and liquidity to homeowners and businesses. I now have a few questions. What is the first thing credit unions should do as they consider taking advantage of this relief?
Thank you, Mr. Chairman. This is Tim Segerson. I'll answer that question. There are two key considerations that should be factored into any plan to take advantage of the delay in obtaining an appraisal. First of all, the delay, as we mentioned, does not exempt or waive an appraisal or written evaluation requirement. It simply allows it to be obtained at a point in time after the origination and funding of the loan to prevent a delay in closing. However, an appraisal must be obtained and a written evaluation must be completed. Credit union management should have a plan ultimately to obtain the appraisal and the written estimate. Two, while credit unions are prudent lenders and credit union management are in the best position to estimate the value of real estate collateral for a loan using less traditional means, management is expected to have a plan in place to address any material loan value shortfalls should they occur. We do not anticipate this will be a significant risk, but expect management to have a plan in place in the event unforeseen events or borrower misrepresentations lead to a significant collateral shortfall. Thank you, Chairman.
Great. Thank you. And I have one final question. You mentioned that this temporary rule, if passed by the board, would expire on December 31st, 2020. What are the implications for credit union as it relates to timing?
Thank you, Mr. Chairman. This is Tim Segerson again, and I'll answer that question. The 120-day delay is measured from the date of closing during the period this temporary measure is in effect. Therefore, a credit union that closes and funds a mortgage on December 31st, 2020 will have until April 30th, 2020 to obtain an appraisal or a written estimate of market value. We believe this provides optimum flexibility for a credit union while maintaining the integrity of our appraisal rules that are intended to help assure safe and sound real estate lending in a credit union system. And one final comment, there is a provision to allow for an extension should the conditions on the ground continue through the end of the year. Thank you, Chairman.
Thank you, and I have no further questions. I'd now like to recognize Board Member Harper.
Thank you, Mr. Chairman, and Tim and Ian, thank you for your informative briefing this morning. And thank you to everyone in the Office of Examination and Insurance and the Office of General Counsel who worked on this interim final rule on real estate appraisal relief. In light of state and local government restrictions on non-essential movement, stay-at-home orders, and social distancing mandates presently required to fight the spread of COVID-19, this real estate appraisal relief rule makes common sense. The scientific recommended efforts to fight the pandemic are good, but they make it harder to complete appraisals before a mortgage transaction closes, precisely at a time when mortgage rates have fallen significantly and consumers want to expeditiously get access to credit at lower rates. As a result, the interim final rule would allow credit unions to defer appraisals and written estimates of market value for a grace period of up to 120 days after loan closing for covered transactions until December 31st, 2020. I should emphasize that this temporary, short-term deferral of an appraisal is not a waiver of an appraisal, because appraisals and written estimates of market value are being deferred, not waived. Credit unions will need to take steps to document the value within the required deferral timeframes, and the proposal contains guardrails to ensure that such estimates happen and what will happen if a property is incorrectly valued. Additionally, like the COVID-19 regulatory relief rule that we just considered, this interim final rule is both targeted and temporary. This interim rule will be another tool for credit unions to use as they work to keep real estate markets liquid during the COVID-19 crisis. And the demand for mortgage refinancing is great. In fact, data collected by the Mortgage Bankers Association through its refinancing index show that there has been year over year a nearly 500% increase in refinancing activity over the same week in mid-March in 2019. This interim final rule, therefore, has the potential to provide credit union members a quicker reduction in monthly payments and expeditious access to inexpensive credit. For families who have experienced declines in household income because of COVID-19, these refinancing opportunities may be the lifeline needed to get back on their feet. Finally, the interim final rule is consistent with the regulation approved by other prudential regulators earlier this week. For all these reasons, I will vote in favor of this interim final rule. Thank you again to the staff who worked quickly to put this proposal together. I have no questions and no further comments at this time, Mr. Chairman.
Thank you, Board Member Harper. I would now like to recognize Board Member McWaters.
Thank you, Mr. Chairman. We have established that this proposed rule represents a deferral and not an exemption, which means that if a credit union uses it, the day of reckoning on an appraisal will come later. I can understand how many credit unions may simply not want to avail themselves of the rule, but they may want to do what they can now to get an appraisal so they can tick the box. One thing they may want to do now is the so-called drive-by or desktop appraisal, which is an appraisal where the appraiser does not enter the residence because either the appraiser does not want to enter the residence or the owners don't want the appraiser to enter into the residence. So it's a cobbling together of information and looking at the property from the outside to determine an appraisal. Tim, some credit unions may wonder, what if I get a drive-by appraisal? Is that enough? Am I able to tick the box that I have met the appraisal requirement, or within 120 days do I have to get a non-drive-by appraisal? In other words, do I have to get 2 appraisals, or will the drive-by desktop suffice if I get it today? What are your thoughts on that?
Thank you, Board Member McWaters. This is Tim Segerson again. The answer to your question is that a drive-by appraisal completed by a licensed or certified appraiser meets USPAP standards, and for that reason would meet our regulatory standards as well. Now, the housing agencies have historically required an interior inspection as well as the GSEs. They have also temporarily relaxed those requirements and will accept a drive-by appraisal or a desktop appraisal as well. And both a desktop and a drive-by appraisal do meet USPAP standards as long as they're completed appropriately by the properly licensed appraiser or certified appraiser. Thank you.
Okay, and so that also means that when the NCUA examiners come in, that desktop drive-by appraisal will also be deemed to be sufficient, provided it's done in accordance with the standards for those types of appraisals. Is that correct?
Yes, Board Member McWaters, that's 100% correct.
Okay. Do we have any understanding as to when the requirement of requiring an interior appraisal will come back into existence, and how that will be indicated to the credit union community?
Board Member McWaters, this is Tim again. I don't have that information handy. I've read their bulletins, but I have not. I don't recall the actual dates. What I can tell you is that we are assembling a letter to credit unions that's going to pull all of the appraisal-related information issued by our agency, the changes in the regulations by our agency, as well as our existing flexibilities, as well as the issuances that we've done jointly with the other agencies, in addition to the housing agencies and the GSEs, all together under one umbrella letter so that it's in one place for credit unions to see and avail themselves to.
Okay. Well, I think it's important that we communicate this to credit unions. I mean, appraisers are in the business of rendering appraisals. They're in the business of being paid to render appraisals. They don't like sitting around, I feel confident, not earning a paycheck. And to the extent we can dispel any uncertainty that a drive-by or desktop appraisal done according to those standards for those appraisals is okay, I think we've accomplished a lot, because it would seem to me it would be better for a credit union today to do something like that, tick the box and forget about appraisal on the property, as opposed to having it hanging over the credit union's head, because as we've all noted several times, this is not an exemption from an appraisal. It's only a deferral. So it would, I think, be helpful to articulate that to the credit union community. Thank you. I have no questions. No other questions.
Great. Thank you. Is there a motion?
Yes, Mr. Chairman, this is Board Member Harper. I move that the Board approve Interim Final Rule, Part 722 of NCUA's Rules and Regulations for publication with immediate effective date and a 45-day comment period as attached to the Board Action Memorandum.
Is there a second to the motion?
Yes, Mr. Chairman, I second the motion.
There is a sufficient second. All in favor say aye. All opposed say nay. All opposed,
aye.
All opposed say nay. The ayes have it, and let the record show the motion passed 3-0. The last item on our agenda today is Final Rule, Part 722, Real Estate Appraisal Threshold Levels. Staff presenting, Tim Segerson, Deputy Director, Office of Examination and Insurance, and Ian Marina, Associate General Counsel, Office of General Counsel.
Thank you again, Chairman. This is Tim Segerson. And we're here to present the final rule to amend Part 722 of NCUA's Rules and Regulations. This is a permanent change. It was part of a long-term process that we've been involved in. So I wanted to make sure that we made that clear distinction, that this is, while the timing is right for the current national emergency that we have, it is not a temporary measure as the one we just spoke about. The final rule increases the threshold below which appraisals are not required for residential real estate transactions from $250,000 to $400,000. We presented the notice of proposed rulemaking to the board on November 2019 and received a number of comments from the industry that were generally supportive of the proposal. We've carefully considered the public's comments and recommend no changes to the original proposed rule. The increase is consistent with public policy interest and does not present a threat to safety and soundness. We believe that the increase provides reasonable protection for consumers who purchase 1 to 4 unit single-family residences. We also believe that the threshold will reduce burden for credit unions and their borrowers, especially borrowers in rural parts of the United States. Since the last threshold was increased 18 years ago, residential real estate prices have increased significantly, which has gradually decreased flexibility and increased burden on credit unions and member borrowers. The final rule will reduce burden and restore a level of flexibility comparable to that which credit unions received when we last raised the threshold from $100,000 to $250,000 approximately 18 years ago. The final rule establishes a residential appraisal threshold consistent with the threshold established by the federal banking agencies in October of 2019, also providing parity for credit unions with their banking peers. The final rule includes housekeeping amendments to incorporate the self-implementing requirement for appraisals to be subject to review for compliance with uniform standards of professional appraisal practice in accordance with the Dodd-Frank Act, as well as removing the provisions for the rural exemption, as that exemption will no longer be necessary with the residential threshold set to $400,000. As required by the Dodd-Frank Act, the NCUA has consulted with the Consumer Financial Protection Bureau on the threshold change for residential real estate appraisal requirements and received concurrence from the CFPB that the threshold increase provides reasonable protection for consumers who purchase 1 to 4 unit single-family residences. I'm now going to hand it over to Ian Marina to discuss legislative background, our regulatory timelines, and the comments we received from the public. Ian?
This is Ian Marina, Associate General Counsel speaking. In 1989, Congress passed the Financial Institutions Reform, Recovery, and Enforcement Act, or FIREA. Title 11 of FIREA, as amended on various occasions, directs each regulatory agency to prescribe uniform standards for real estate appraisals in connection with federally related transactions under its jurisdiction. Under FIREA, federally related transactions are generally defined as those real estate-related financial transactions where an agency requires the services of an appraiser. However, each federal regulatory agency has some discretion to establish requirements for when an appraisal is necessary. FIREA explicitly authorizes agencies to set threshold levels at which no appraisal is required. In establishing a threshold level below which no appraisal is required, the NCUA must determine that the threshold does not represent a threat to the safety and soundness of credit unions. It must also receive concurrence from the CFPB that the threshold provides reasonable protection for consumers who purchase 1 to 4 unit single-family residential properties. As Tim noted, the NCUA has received such concurrence with regard to this threshold change. Now, to give some historical background, following enactment of Title 11 of FIREA in 1989, both the NCUA and the other banking agencies set their threshold below which appraisals are not required for residential real estate transactions at $50,000. Those levels were set in 1990. Over time, both the NCUA and the other banking agencies have increased the threshold level below which appraisals are not required for residential real estate transactions. The other banking agencies recently increased their threshold from $250,000 to $400,000, effective in October 2019. They had last adjusted their threshold in 1994. The NCUA's current threshold of $250,000 was last adjusted in 2002. This final rule, if approved by the board, would increase the residential real estate threshold from $250,000 to $400,000 and provide credit unions parity with their banking peers. I'll now briefly discuss the public comments received on the proposed rule. The NCUA received 27 comment letters during the comment period. 22 of the 27 commenters supported the threshold change. Those commenters came largely from credit unions, credit union trade associations, and rural credit unions and rural-focused credit union associations. 5 commenters wrote in opposition to the threshold change and represented the appraisal industry, including professional appraisers, professional appraisal organizations and trade groups, as well as one unaffiliated individual. I'll now briefly note the major points that the commenters raised on the threshold change. Those that supported the threshold increase stated that it would reduce burden and increase flexibility for credit unions, that it would reduce member costs and time, that it would achieve parity with banks, and that it would help rural borrowers. Those that oppose the threshold increase stated that it would not provide adequate consumer protection, that a written estimate of market value is not an adequate substitute for an appraisal. They also pointed to potential to undermine the independence of the valuation process and stated that the lack of an appraisal would reduce safety and soundness. I'll now turn the presentation back to Tim for further discussion of the analysis of the threshold in the final rule.
Thank you, Ian. Raising the threshold to $400,000 for residential appraisals restores the level of coverage comparable to comparable levels achieved during each of the past threshold changes. We evaluated the threshold from a coverage perspective as well as from a price change perspective in evaluating what level we should recommend. In establishing thresholds since 1995, the NCUA exempted a significant level of credit union mortgages from the appraisal requirement. In 1995, we established a threshold at $100,000, exempting approximately 87% of first mortgages from the requirement. In 2002, when we raised the threshold to $250,000, which matched the residential threshold that banks received, we exempted approximately 95% of residential mortgages from the appraisal requirement. And in 2020, this rule would exempt again approximately 94% of first mortgages. Over time, a static threshold becomes increasingly burdensome for consumers and financial institutions providing mortgage services. As property prices increase, the level of coverage by the more stringent appraisal requirements increases as a percent of the population of loans originated. Raising the threshold from time to time restores flexibility and reduces the increasing burden. We found a similar pattern when we looked at dollar volume transactions and concluded that the threshold will once again restore the dollar volume measure to approximately 83%, which is consistent with the threshold increases in 1995 and 2002. This information is based on HMDA first mortgage data for credit unions. Likewise, when we compare the $400,000 threshold to various real estate price indices over time, we see that a $400,000 threshold is in line with price changes. Using 2002 as a base year when we increased the threshold to $250,000, and following price increases over the last 18 years, both Case-Shiller and the FHFA home price indices support a current threshold of approximately $450,000. The consumer price index, using the consumer price index as a base for the same period, would support a threshold increase of approximately $360,000. $400,000, which is our recommended threshold, is supported by market price changes over the years and puts credit unions on an even footing with banks. From a safety and soundness perspective, we estimate that the increase to the threshold incrementally affects less than 1% of the credit union system's total assets, or approximately 18% of first mortgage transactions. Using, again, HMDA data for 2018 as the source, credit unions reported originating approximately $78 billion in first mortgages in 2018. Under the current rules, with applicable exemptions and thresholds, $29 billion in originations were sold to GSEs or guaranteed by housing agencies such as the VA or FHA, exempting them from the NCUA appraisal regulations. Another $27 billion in originations were below the existing $250,000 threshold. And then another $8 billion in originations were transactions equal to or greater than $400,000. So of the $78 billion, this leaves about 18% of that pool, or $14 billion, in first mortgages that will be or are affected by the threshold change. As I indicated, this represents about 1% of credit union system assets, but it also provides relief for approximately 46,000 mortgage transactions. As a final note on safety and soundness implications, we studied problem loan and loss history for credit unions' first mortgage portfolios over the last 25 years. We reviewed portfolio loss rates and performance trends with each of the last 3 threshold changes, as well as portfolio performance during stressed economic times. We found no change in portfolio performance or problem loan and loss trends after subsequent threshold changes. Performance remained stable. In addition, we recognize that credit union portfolios have actually performed markedly better than the overall industry averages during stressed economic periods, including our recent experience during the Great Recession of 2007 to 2009. Relative to credit union system assets, the incremental level of residential transactions affected does not present a safety and soundness risk. If the final rule is approved, residential transactions under $400,000 will not require appraisals, but they will require written estimates of market value. A written estimate of market value prepared by qualified and experienced individuals generally provides sufficient information to enable credit unions to make prudent credit decisions. Written estimates have been required for transactions under the $250,000 threshold since 2002. The NCUA and other banking agencies have established expectations through the 2010 published interagency guidelines on appraisals and valuations, setting appropriate expectations for independence, qualifications, and content of written estimates of value. The guidelines state that a written estimate of market value should provide a reliable estimate of property's market value and have sufficient information and analysis to support the credit decision. Furthermore, as is the current practice, credit unions and borrowers may obtain appraisals to establish collateral value even if a transaction exempt from the appraisal requirement. The guidelines advise credit unions to develop policies and procedures for identifying instances when this would be prudent. We conducted a brief study to determine if and how often credit unions would obtain or do obtain an appraisal when not required, and found that in the majority of cases, credit unions obtain appraisals for transactions under the current $250,000 threshold. We found approximately 60% of institutions sampled order appraisals all the time or most of the time for mortgage transactions under the current $250,000 threshold. Once again, we find that credit unions have very prudent lending practices when it comes to mortgage lending. We believe written estimates of market value are a proven and safe alternative for transactions below the applicable threshold. Written estimates provide sufficient information for consumers to make informed decisions for transactions below the threshold, and when combined with other consumer protection laws, provide reasonable protection for consumers. Finally, we believe this rule will lead to time and cost savings for borrowers and credit unions, particularly those in rural areas where we found that appraisals could cost significantly more and take significantly longer to obtain. Mr. Chairman, this concludes our remarks. We recommend that the board approve the final rule raising the threshold, residential threshold, where an appraisal is required from $250,000 to $400,000, and we'll be happy to answer any questions.
Great. Well, thank you for your presentation, and I'd also like to thank you and your teams as well for their hard work that went into this proposal. This rule continues our updates to the NCUA's appraisal regulation and looks to increase the appraisal threshold for residential transactions from $250,000 to $400,000. This final rule is prudent and strikes the right balance for credit unions, their member owners, and the Share Insurance Fund. Credit union leaders have consistently approached me about this rule and expressed their support, especially now during the public health emergency that surrounds the COVID-19 pandemic. The NCUA is focused on giving credit unions the flexibility they need to respond to the needs of borrowers who are facing stress. As our nation deals with the challenges of a national public health emergency, this rule will facilitate lending and the process by which credit union members buy, sell, or refinance their homes, while also ensuring the safety and soundness of credit unions. I've heard from a number of credit unions, especially those serving members in rural areas, that appraisals can cost from $500 to $1,000 and can take as long as 6 to 8 weeks to obtain in rural communities. This rule provides needed flexibility that can allow credit unions to safely expedite the lending process and reduce transaction costs, a real benefit to credit unions and borrowers. I was pleased to see comment letters from credit union stakeholders supporting today's rule and recognizing its regulatory relief, reduced member costs, increased access to credit, and reasonable protection for consumers. This is a prudent, common sense adjustment that will benefit both lenders and borrowers by lowering costs and reducing the time needed to complete residential lending transactions. As with other regulatory reforms, this was not an issue we approached lightly. We carefully studied market conditions, assessed industry norms, and consulted with stakeholders to determine the appropriate way to proceed. That due diligence meant that we could move forward with confidence that this reform would not compromise the safety and soundness of the credit union industry. I want to highlight a few key points that speak to the safety and soundness of the final rule and related consumer protection considerations. First, credit unions prudently underwrite residential real estate loans. Residential real estate portfolios and credit unions performed well during previous economic cycles, including during the Great Recession, and experienced comparatively lower losses and charge-offs during those cycles. Second, credit unions typically use underwriting standards set by Fannie Mae and Freddie Mac to be able to access the secondary market. In fact, over a third of residential originations are sold to Fannie Mae and Freddie Mac or issued through government-guaranteed programs such as the Federal Housing Administration, Veterans Affairs, USDA Rural Housing Service, or Farm Service Agency. As a result, and combined with the fact that credit unions are selling many of their residential mortgages to Fannie Mae and Freddie Mac, the threshold increases only affects a small portion, less than 1% of credit union system assets. Third, the rule provides flexibility for credit unions to choose an appraisal or a written estimate of fair value, or it's the estimate of value. Finally, written estimates of market value are still generally required for transactions below the threshold. And in addition to above average performance of credit union real estate loan portfolios, even during stressed economies, the NCUA has not experienced performance issues with written estimates of market value. Written estimates of market value prepared by qualified and experienced individuals enable credit unions to make prudent credit decisions. Several comment letters from the appraisal industry raised concerns about the rule's effect on consumer protection. Let me reiterate that this rule does not undermine consumer protection. The CFPB has determined that the $400,000 residential real estate appraisal threshold, and I quote, provides reasonable protection for consumers who purchase 1 to 4 single-family residences, I end quote. In addition, many other protections exist for borrowers and other related laws and regulations, including the Valuation Independence Rule, High Price Mortgage Loan Appraisal Rule, Real Estate Settlement Procedures Act, and the Equal Credit Opportunity Act. Credit unions will still be expected, as always, to wisely manage risk in their loan portfolios and to ensure they continue to follow appropriate lending practices. In fact, credit unions are already well known for their prudent approach to underwriting residential real estate loans. We expect that to remain true after the new appraisal threshold takes effect. Home ownership is essential to building strong communities, and a strong housing market is a vital driver of economic growth within the broader economy. At the same time, we recognize that the process of securing a loan and purchasing a home can be time-consuming and stressful, especially for middle and working-class borrowers and those who live in underserved areas, and again, especially those who are low to moderate income and of modest means. This common-sense adjustment to the appraisal threshold for residential real estate transactions is a timely regulatory reform that will serve lenders and borrowers well. I now have a few questions. How does this rule make it easier for borrowers to buy, sell, or refinance their homes during the COVID-19 epidemic?
Mr. Chairman, this is Tim Segerson. I'll answer that question. Generally, a written estimate of market value takes less time and costs less money than a full appraisal. So the first answer to that question is that it can be done quicker with a faster turnaround, and it will cost less money to the consumer. Credit unions can conduct them themselves if they have the appropriately qualified staff, or they can also contract third parties to get written estimates. They must be qualified and experienced and independent of the transaction. But again, the timing is the primary issue, where the loan can be brought to completion or closing quicker. Thank you.
Great, thank you. And I do have one other question. You mentioned rural areas. I saw several commenters that sort of highlighted that this rule will improve access in rural America. Can you elaborate how this rule will benefit credit unions helping members obtain mortgages in rural areas or underserved populations?
Yes, our analysis shows that rural areas benefit from this rule in the same proportion as the rest of the population. Rural-related commenters were pleased with the threshold increase because credit unions in those areas and associations viewed the time and cost savings for credit unions and borrowers in rural areas to be sizable. And that is because generally the time it takes to complete a written estimate of market value may often be shorter than the time it takes to complete a full USPAV appraisal by a licensed and certified appraiser. In addition, they generally cost less. One final comment. As you mentioned, commenters, we have seen commentary along those lines with the commenters that there have been situations where, for example, an appraiser may wait on conducting an appraisal until they have 2 or 3 jobs in the same area because of the extensive travel that's required with that. And that extensive travel can also significantly increase the cost of an appraisal in a rural area compared to an urban or suburban setting. Thank you, Chairman.
Great. I have no further questions, but I would like to take a moment to recognize you, Tim Segerson. Ladies and gentlemen, Tim Segerson has just been announced as the new chairman of the Federal Financial Institutions Examination Council, known as FIFIAC, as the new chairman of the Appraisal Subcommittee. So, Tim, I'd like to acknowledge this accomplishment and to applaud you. And also thank you not only for your leadership here at NCUA, but also among our colleagues on the FIFIAC Council. So congratulations and well done.
Thank you, Chairman.
I now would like to recognize Board Member Harper.
Thank you, Mr. Chairman. And Tim, my heartiest of congratulations to you on assuming the chairmanship of the Appraisal Subcommittee. It is, you've worked for it for many years. You have been instrumental on appraisal issues, and I know that the Appraisal Subcommittee will be well served under your leadership. I also want to thank you, Tim and Ian, for your presentation today, as well as Uduak, Lou, Kenneth, Jira, and Frank for your hard work on this rulemaking. So far, I have supported each of the items that have come before us today. I did so because these regulatory matters were temporary in timing, targeted in scope, and related to mitigating the effects of the COVID-19 pandemic on the credit union system. In comparison, this final rule does not directly respond to the COVID-19 emergency. As a board, we should focus our energies on protecting the people, including the NCUA staff, credit union members, and employees, preparing the agency, and strengthening the system for what lies ahead. Rulemakings like increasing the appraisal threshold can wait as we prioritize a new economic reality. I therefore will oppose this rule. With this rulemaking, we are putting the proverbial cart before the horse by raising the threshold before acting on an interagency rule to establish standards for automated valuation models, or AVM. Although credit unions cannot rely solely on AVMs when calculating a written estimate of market value, the estimates produced by AVM may contribute to the valuation. When we considered this proposal last fall, I noted the lack of quality control standards for AVM. My concerns are not isolated. In 2018, the Federal Reserve Board found that the, quote, degree of precision, unquote, for AVM was low, and only half of AVM estimates were, quote, within 10% of the sales price, unquote. Congress also recognizes the problematic nature of AVM quotes. The Dodd-Frank Act required that AVM adhere to quality control standards designed to ensure a high level of confidence in the estimates produced. To implement these standards, the law required the NCUA, the federal banking agencies, and the Appraisal Subcommittee to develop new rules. Nearly 10 years have passed since the Dodd-Frank Act became law. While there have been some interagency discussions about the AVM standards in recent months, regulators have moved at a glacial pace on that mandatory rulemaking. Another troubling thing about this rule is the size of the threshold. Under the new appraisal threshold, 94% of residential mortgages underwritten by federally insured credit unions would be exempt. This excessive exemption is far from what Congress intended. In fact, lawmakers recently asked the Government Accountability Office to study the appraisal threshold, including how to preserve the safety and soundness of the financial system and protect homeowners from mortgages with inaccurate valuations. Rather than rush to loosen this standard in the midst of a dramatic economic downturn, we should wait to act on this issue until that independent analysis is complete and the economy stabilizes. Moreover, the present economic downturn may eventually lead to lower home prices. If so, then credit union members whose mortgages relied on a written estimate of market value might find themselves in overinflated mortgages. Licensed and certified appraisers are more likely to identify and adjust to downward price trends than professionals with less training in estimating property values and AVMs, whose estimates can lag the market and which could produce less precise estimates of market value. Additionally, as noted in the final rule, written estimates of market value are less regulated than appraisals. And as the National Association of Federally Insured Credit Unions wrote in its comment letter, Chapter 10 of the NCUA's Examiner's Guide, quote, provides little insight on the expectations for written estimates of market value, unquote. Before finalizing this rule, we should provide details about the training, expertise, and knowledge required by independent parties who will be making written estimates of market value, as well as a standard written format. However, to do that, the NCUA would have to take time away from our efforts to address the COVID-19 pandemic. In closing, the matter before us is the wrong rule at the wrong time. It is neither temporary nor targeted. Instead, it is permanent and premature. In these challenging times, the NCUA should apply a laser-like focus that responds to the economic impacts caused by COVID-19. And consistent with the best practices of consumer protection and the principles of safety and soundness, we should ensure that credit unions continue to meet their members' pressing needs, many of whom have lost their jobs and some or all of their income in this crisis. Raising the appraisal threshold does not achieve the objective of supporting those who are now experiencing hard times through no fault of their own. Accordingly, I will vote no on this matter. I have no further comments, Mr. Chairman. Thank you.
Thank you, Board Member Harper. I'd like to now recognize Board Member McWaters.
Thank you, Mr. Chairman. I am certainly sympathetic to the consumer protection issues raised by both of my colleagues here. I think I articulated that fairly clearly in my December 2019 board statement. I also believe there is a nexus in this rule to COVID-19. After all, the rule we just talked about, and that was extending the appraisal deadline by 120 days. And so if we change the appraisal threshold from $250,000 to $400,000, then presumably there will be fewer of these appraisals that will have to be extended. And I think that's generally a good idea. I also am concerned that if we don't increase this threshold from 250 to 400, we are going to place credit unions at a competitive disadvantage to banks, and that into itself could create a safety and soundness issue. But to me, most importantly, when I look at the $250,000 number, I realized that it came into effect in 2002. So if that rule had been indexed by inflation under the Case-Shiller Index, over the last 18 years, merely by inflation, it would today be $457,942, which means an indexed threshold in 2002 would not require an appraisal unless it was over basically $458,000. If it had been indexed to the FHFA, the threshold would be $451,050. If it had been simply indexed to the Consumer Price Index, it would be $363,828. Over the last 18 years, housing prices have, without a doubt, definitely inflated. There was a huge downturn in 2008, 2009, but a substantial recovery. And as Board Member Harper notes, there's some uncertainty in the market now as to what will happen. but just simply by looking at this from an inflationary perspective, the $400,000 number seems, if anything, perhaps a bit low than an inflationary adjustment. So for these reasons, I will support the rule. And Mr. Chairman, I have no questions.
Thank you, Board Member McWaters. Is there a motion?
Yes, Mr. Chairman. I move that the Board approve final rule, Part 722 of NCUA's Rules and Regulations as attached to the Board Action Memorandum.
Is there a second to the motion? Hearing none, I second the motion. All in favor say aye.
Aye.
All opposed say nay.
Nay.
The ayes have it, and let the record show the motion passes 2-1. Before I end today's meeting, I would like to conclude first by thanking the 1,141 men and women of NCUA for their dedication and professionalism that they have shown throughout our work in addressing the issues related to COVID-19. Each and every day, they are working not only to keep their families and themselves safe, but they're also working on behalf of the 120 million members of our credit union system. And I want to just applaud them and thank them and hope that they all stay safe and healthy. And with that being said, thank you all for a very productive meeting today. I would be remiss if I did not also thank the Office of the Chief Information Office. They have continued to give us the tools and resources we need to not only just work and get our mission critical work done remotely, but to also host today's first open board meeting remotely. So thank you all. This meeting is officially adjourned. Thank you.